In 2001, you could buy a share of Amazon for as little as 28 cents. Even as investors and the media were writing off Amazon, Jeff Bezos was reassuring employees not to look at the stock price because the company's business was booming. And that's the bottom line.
The stock is not the company, and the company is not the stock.
Many companies are in a similar situation these days. How to benefit from it? In the current uncertain economic times, with markets reeling under the impact of President Donald Trump's new tariffs, it's important to know what to look for in the market. Although the market crash is worrying, it doesn't mean that all investors should sell off their portfolios. Look at Amazon. That's a company that every investor knows today. It is a true giant in its field, and despite this, it too has faced some rough sell-offs and downturns, which it has eventually managed to overcome. That's just one example of what's happening to many companies right now. How do you pick these winners? Warren Buffett is a prime example of an investor who can navigate volatile market conditions. He has led his investment company, Berkshire Hathaway, through numerous stock market crashes and countless corrections since the 1960s. But he has always managed to overcome them with grace. And Berkshire's investment portfolio has subsequently achieved an average annual return of just under 20%, double the average of the US stock market. The share price was rightly rewarded with a rise. The current return to volatility in equities comes at a time when investor concerns about US tariffs and ever-increasing inflation are growing. It is this advice and insight that the Oracle of Omaha offers investors to navigate these troubled waters. The one piece of advice we bid on in the introduction is also the most important. Stock prices are driven by short-term investor sentiment. In the long run, however, it is the company behind the stock that ultimately delivers returns to shareholders. And Buffett, as a long-term oriented investor, is always focused on what the company itself looks like. Specifically, Buffett looks for top companies with clear competitive advantages that create a moat of protection against competitors. Having an edge in the form of a reputable brand or industry-leading margins and efficiencies can make a huge difference in the long run. And when businesses with these winning qualities are sold by panicked investors, Buffett, in turn, begins to prepare to buy and grow. The number of subscribers to our channel is also growing strongly, so make sure you don't miss any more top news from the world of stocks and markets. In essence, it's very simple, but it's hard to follow. Emotions that make investors or traders jump in and out of positions are the biggest enemy. But if you can tame them, you haven't completely won. Then you need to find quality companies to buy. How do you understand the market so that you can find these stocks and not succumb to market pitfalls like the well-known FOMO? For one thing, you can of course check out 𝗕𝗂𝗶ecie, which will provide you with all the information and data you need in this challenging period, or keep watching this video. Imagine the following situation. You buy Apple stock at $170 a piece. After a while, complications arise. Maybe a new product doesn't come out, the supply chain gets stuck, and suddenly those same shares are only $100. Does that mean someone took $70 for each share? The money didn't move anywhere. What's changed is the perception of value. The market, driven by investor emotions and expectations, has determined that Apple is now worth less. Much like a new car that loses value as soon as you drive it out of the dealership. This change is referred to as an unrealized loss, a loss that exists only on paper. Only if you decide to sell the stock at the new lower price does it become a realized loss, resulting in an actual withdrawal of money from your account. And it is at this point that the drama of the investment world begins. You will recall the famous scene from The Wolf of Wall Street, when Matthew McConaughey explains this exact principle to Leonardo DiCaprio. So how is the share price actually determined? Stock prices are based on the most basic economic principle, supply and demand. When more people want to buy a share than sell it, its price rises, because buyers are willing to pay more. Conversely, when they panic and sell while there are few buyers, the price falls. This dynamic plays on investors' nerves every day, especially in this uncertain moment when everyone has a completely different scenario for tomorrow. And it is often the case that prices fluctuate not because of reality, but because of assumptions. Let's look at Tesla. Between 2020 and 2021, its stock rose more than 700%, despite the global pandemic. Investors back then believed Tesla would change the world, that electric cars were the future, and Elon Musk the one to get them into every garage. The result was a market capitalization of over $800 billion, even though the company was producing many times fewer cars than traditional car companies. The reverse is the case of Netflix in 2022, when the stock plummeted by 70% after failing to meet estimates for the number of new subscribers, or Amazon in 2000. The company's business has not been damaged. On the contrary, it has done very well. However, concerns about competition or changes in market trends are the main drivers of the price in the short term. In the long term, these fluctuations are completely irrelevant. And that is exactly what Warren Buffett says. Whenever there is an opportunity in the market when stocks, or literally dozens of stocks, are below their fair intrinsic values, that is the time when investors start to build their wealth. While it may seem that the markets will fall further, and the end of uncertainty is in sight, this is the time 𝗕𝗂𝗹𝗶cie buy quality businesses. Because in the long run, these quality investments will eventually pay off. Losses are not always logical. They are often psychological. Not just Buffett, but all great investors in the past have been able to use these downturns to buy. Their goal is not to pick the bottom, which an experienced investor shouldn't even try to do, but to buy a very high-quality company below its fair price. Every stock has an intrinsic value, the price the company is truly worth based on its earnings, assets, and potential. But market value is about how much people are willing to pay for it right now. It is important to distinguish these two values from each other. The Fair Price Index on 𝗕𝗂𝗋𝗈 is a great way to help you with this, providing you with these intrinsic values for thousands of companies, calculated based on DCF and relative valuations. This way, you don't have to spend dozens of hours on a complex calculation, which you can supplement with high-quality analysis that you can find the data for right in the stock's detail. Want to know the cash flow, balance sheet, or PE? No problem. You'll find all of this on 𝗕𝗂𝗋𝗈 with lots of other useful features, so check it out. Big crashes like this show how the value of a stock can drop significantly in a matter of weeks. Historically, these declines have been the biggest opportunities in the market. So feel free to visit 𝗕𝗂𝗋𝗈 and chat with the community of investors who are now taking advantage of this situation and buying top-quality stocks at a discount. There will be another video coming out on Friday with updates on the current situation, so be sure to subscribe so you don't miss out. Share with other investors how your portfolio is doing, or what stocks you are going to buy, or post it here in the comments. Good luck with your investments.